There. Hey, good morning. The market is opened. It's been open for about a half hour, and I am joined by Daryl. And we're going to
Hello.
take a look at the big earnings that happened today. How you doing this morning, Daryl?
Doing very well. How about you?
I'm doing great. Doing great. Looking forward
Fantastic.
to. Go ahead.
I said fantastic. I'm glad to hear it.
So we're going to look at stocks this morning. We're going to look at McDonald's. We're going to look at Disney, Uber, Shopify, and Jackson Financial. And we're going to look at them two ways. We're going to look at the fundamentals, try to see from a value perspective, are the stocks discounted? Are they priced at a premium? And Daryl is going to look at the technical charts and see how that's setting up, see if he believes that they're setting up to rally or they're setting up to maybe go down in price. So the market is not sure of itself. A couple of stocks are certainly doing well. Apple is up. Looks like some safety stocks are up, like Costco, Walmart. Energy's up. I think oil prices are up. McDonald's is up. We're going to cover McDonald's. But certain spaces like healthcare, again, is getting taken down. That's probably the worst area of the market. We're going to cover Uber. It's down. And we'll examine what Uber has going on. And I'll certainly provide some comments there. Disney is down substantially. We'll examine that and see on over at Disney. AMD is down. They announced, did they announce? Yeah, they announced yesterday, I think, after the market closed. Looks like the stock's under pressure. All right, to get things started, we're going to talk about McDonald's. McDonald's is the stock is up 2.44%. It does pay a nice dividend, 2.32%, and it's a pretty steady stock. I consider this a safety stock. If we have a recession, boy, the pricing at McDonald's looks pretty darn attractive to somebody who's on a budget. I always consider it that way. I think there's a small discount on the stock, and the market did like their earnings. They grew a little bit, and I'll get to that in a minute. They grew. Is their balance sheet is not my favorite. They carry a lot, 50 billion, and that's always been kind of a little bit of a concern for me. It's above a debt to EBITDA of 3, which is a concern to me. And it's not a growth stock. It just doesn't do a lot for me personally. But I imagine this is a good stock for some people that are looking for something they can really understand easily. They get paid a dividend. It's going to be a stock that I don't imagine it ever being off the it's just going to be a good stable. Looking at earnings, they had growth of 3.8%. That looks pretty decent. And across the US, 2.5, internationally 4%, so that looks good. Just a pretty steady stock. This one here, I don't know how the stock has traded for the last year. Let's see here, 14% plus that dividend. That's pretty good. 5-year, 54% plus the dividend over 5 years. You're probably in the neighborhood of 65% rate of return. On a safety stock, I think that's the job done. So what do you think of McDonald's, Daryl?
Most of the 1-year growth occurred in from August to October of last year. Since then, it's pretty much been flat. You can see it was trading about 312 and it's trading at 306 right now. So it's been trading sideways pretty much since February. It is trading above an upward sloping 20. a downward sloping 50. Does have good RSI. PPO, excuse me, has been negative for nearly 2 months. It has moved into positive territory. Accumulation's been good since about November of last year. They do have positive money flow at the moment. They are underperforming the S&P 500. They are over the past year. McDonald's is underperforming the discretionary sector, slightly outperforming the restaurant industry, just barely, and it just started doing that, looks like this week. And it's under the restaurant industry is underperforming the SPY. They are up today, we can see. So I don't know, it looks kind of neutral to me, but they're definitely a stalwart stock, that's for sure.
Yeah, it's a steady stock, and it's, I don't like to say anything bad about it, because it's just steady as she goes.
Yeah.
For some investors, they like it, and not going to point anything bad about it other than the balance sheet. It's not the right stock for me. It's the right stock for a lot of investors. Easy to understand that stock. So looks like we've got a good number of attendees on the live stream. Thanks everybody for joining us. I think this is the first watch party in the morning. So we usually do them right at 1 p.m. We've got Little J, new member of my channel. Good to see you, Little J. And I think you were on the stream Monday. Peyton, good to see you. Carlos, great to see you. Russ, thanks for checking in. Glad that you like McDonald's and good earnings from them. Hopefully your portfolio's up nicely.
He's one of their big cheerleaders.
Yeah.
I'm in another Discord with Russ, and he's definitely a McDonald's cheerleader.
All right. Well, there's something to cheer about today.
Exactly.
So Peyton wanted to look at symbol KVYO. We'll take a look at that. Peyton, we want to get through 4 earnings. We just did number 1, and then actually 5 earnings. We just did number 1. So right after we get done with that, we will cover KVYO. So thanks for tuning in, and go A-Lab. Absolutely. Nice. Perfect. So that is McDonald's. If we can switch gears and talk about Disney, and I'll kind of let you go over Disney first since you've already got the screen, and then I'll cover fundamentals.
Sure. So they did peak out at the end of June. Back in December, they had hit 117 or so. That was their high for several months. They have broke out above that. I heard this morning that their entertainment part of their business was doing pretty well, but the streaming part wasn't doing so well, and that's probably what is driving the price down this morning. They are trading above an upward sloping 200, trading below an upward sloping 50-day, and the 20-day is downward sloping. They have negative RSI. They're below the midpoint of 50. As we've talked about in several of these live streams, whenever I see the price doing this and momentum doing that, that's always a cautionary flag for me. It's called a negative divergence. Looks like today they're actually moving into negative territory. They're moving below their midpoint of 0. Accumulation's been good, but it has decreased since about the beginning of July. The money flow is negative. is improving. It's kind of in no man's land when it sits below or sits above minus 0.05 and below 0.05, so right around zero. It's hard to tell which way the money flow is going to go. So it's kind of in no man's land there. It has outperformed the S&P 500 over the last year. It is underperforming as of today, the communication sector. Let's see, they are in the entertainment industry, and they are outperforming that industry group. But that industry group overall is underperforming the SPX. So I don't know where Disney's necessarily going to go from here. It looks like they had a lot of selling early in the morning, and the price has recovered back up to 114 currently, where it was down to about 112. So there was some early morning selling. It looks like could be a down day today overall.
Yeah, and Disney, just to kind of get things started, I think Disney could have done a better job of selling off assets that were going to underperform. I mean, the world has changed drastically over the last 30 years. Back 30 years ago, the cable business was so darn lucrative for them, right? At ESPN, which was a part of every single bundle, so much money on that. The Disney Channel, I mean, what parent with young kids didn't have the Disney Channel? But those times have really changed. The streaming era has completely put that model on its ear. The other thing too is they have businesses that are, theme park oriented, and they have a studio, and their studio is probably the best run studio in Hollywood, in my opinion, because they have a lot of franchises that continue to just produce revenue and cash flow, and they're reliable, like Star Wars, and of course the other movies that Disney puts out. So I get all that, but at the end of the day, nowadays, the most valuable companies in communication services are Facebook, Meta, Google Alphabet, and Google Alphabet has YouTube. So Netflix has outperformed Walt Disney for the last 5 years. So I think it's been a little bit of, they're kind of caught in too many eras. They have businesses that were great 50 years ago, businesses that were great 25 years ago, and they have businesses that are really great right now. I think the streaming business is really good.
Yeah,
So
they have the cruise business as well.
Yeah. Now, General Electric, they've had, I think, very good leadership. General Electric split up. They're like, you know what? We had rough times trying to be one unit or one company with three separate types of businesses, and they said, no, let's split them up. And they've split up General Electric in three pieces. Really good strategy, because now each of those businesses is flourishing. Disney may want to think about that, because I think they're in too many markets. They should have a CEO that focuses on the cruises and the theme parks and all that good stuff. That could be a business on its own. The streaming business, the new generation business can be a business on its own. And I don't know what else they own. The studio can be spun out, and hey, you know what, studio. And I guess the studio could still be part of the streaming business, but it's just a lot of things kind of operating together, and it seems like some of the businesses just don't perform. Therefore, when we look at their growth, it's not great. It's 5% growth trailing 12 months, but the most recent quarter, 2% growth. It's not good. And it's contracting a little bit from the growth rate. So I'm not excited about Disney. I haven't been excited about Disney in a long time. I owned Disney like 30 years ago, 25 years ago. And back then, man, Disney was like a powerhouse, but they have not been that powerhouse for a while. They are a good business. They generate good cash flow. They definitely have some brands that are really, really valuable. It just seems like their business is not optimized. Look at this cash flow. It's just not going, it doesn't have an upward trajectory. It's all over the place. You had a good year, a bad year, a good year, a bad year, a good year, a bad year. It's like, come on, guys. No consistency. And gross margins are somewhat low. And so overall, I think it's a business that strategically I'm not in love with. Wouldn't label it a very desirable business. I would label it a moderately desirable business. I think they can split it up, probably make it stronger. Each piece would be stronger that they split up. When I value Disney, I come up with a 25% discount. And, that's a pretty adequate discount. But I, first and foremost, need to buy into the business. High level qualitative decision is I'm looking for a great business. Could be a turnaround story. They've got great assets. They've had a couple hard years. They've put things back together. They're heading in the direction. And 3M is an example. I bought 3M. That's going okay. It's going reasonably good. And they split up a couple of their businesses, spun them off. They became more focused and a better. So that might be something to foresee. And of course, they have a CEO that came back from his retirement because the CEO that was his replacement, his successor, I guess 6 years ago, 7 years, I guess 6 years ago, he didn't pan out. The business he got in a couple of like bad situations. He did not guide the company quite well. So the current CEO is a good guy. I think he's done a great job, but he's not going to be there forever. He retired 6 years ago for a reason. He probably wants to be retired. So you should replace him with somebody who's really excited about the company, is ready to evangelize the company and kind of lead it for the next decade. So that is Disney. One thing that I didn't cover was their dividend. They pay a small dividend of 0.88%. And I'm sure they can cover that dividend. It's not very much. But it's not a stock that I've owned, 20 years, but did own it a long time ago. That is Disney.
What are the analysts saying? I see they have a strong buy on it.
Who?
The analysts.
All right. So they have 21 cover the stock. And they do have a strong buy. They say it's 10% discounted. I have a better discount than they do.
Yeah, you sure do.
So it's like, how can you say strong buy and it's only discounted by 10%? I don't know. But best price target is 147 and the worst one is 95, consensus 130. So yeah, that's Disney. Can we move on to Uber?
Sure.
All right. Uber is under some pressure. I did review their financials in detail and I have a full valuation on Uber. Let's take a look at their earnings first. So they grew at 18%, excellent. They expanded their profitability, excellent. Free cash flow is better than expected, very good. All those things really looked good. What's always in the mix is Uber is in a market that is quickly changing before our eyes, right? We have human-driven Uber cars that give us rides, and it's expected that the robo-taxis are going to be a pretty big part of the market. I think that's what is going to compete against the Uber business in a way. If they don't take advantage of it, I think they should really go out of their way to try to partner with Waymo and try to grow the robo-taxi business. But the business overall is doing great. If they can continue to grow at these rates, all in. I'm already a big stockholder of Uber, so I'll put that out there. Up 49% over the 1 year. It's a $181 billion market cap. Revenue is $47 billion. Not too expensive. 4.76 PE. That's pretty rational. They're growing at 18%. 27 next year. Strong buy, 17% discount. And financials are updated. Look at this green on the screen. Very nice. Already a $47.3 billion revenue business. Free cash flow has really taken off. Why do they produce so much free cash flow? Well, they don't have to buy any cars, and they don't have to hire any drivers. Drivers are basically gig economy workers, and those drivers will buy their own cars and provide that vehicle. So that's a model that enables them to keep growing without having to put a lot of capital into the business, and just really generating tremendous cash flow, which ends up being a very good valuation for me. Smart, lower than a software technology business. Their free cash flows are great, profit margins are great, really good.
Victor, I don't know whether it's your connection or my connection, but every once in a while you freeze up for about 8 seconds.
Yeah, it's probably my connection. I'm traveling, and this hotel, the internet hasn't been great.
Okay.
So we've got 32 analysts, plenty of opinions on Uber. Some analysts believe it's really going to go up, and some analysts think it can come down a little bit, not too much downside risk, but it should go up, according to analysts, about 17% if it's going to be priced fairly. And when we look at their growth, going to keep growing. So a lot of these stories that, robotaxi is going to disrupt them, they may be relevant. They may be realistic. Like, hey, robotaxi most definitely might take a percentage of this category, right? But when you look at these forecasts, I'm like, geez, these guys are going to keep growing. They're going to be a $75 billion market revenue company in 2028. This looks terrific to me. Really good. And they're going to expand their profitability. So these things the numbers look great. Cash flow looks great. Profits look great. And their valuation, I disagree with the consensus. I think Uber has a very large discount. Just the way their cash flows are coming in and they're growing, the cash flows are worth a lot. You're looking at a run rate now, looking forward for the next 12 months, I expect they're going to do about 9.5 billion in cash flow. And then they're going to grow those cash flows by 22% for the first 4 years and continue to grow. This is a very fertile, large addressable market. So those cash flows are worth a lot. They have good cash on the balance sheet, a little bit of debt. So their overall equity value is quite high, 451 billion, based on my research and analysis. So they present a nice discount if I look at cash flows. Earnings per share also reveal a nice discount, 41%. So I'm a buyer of Uber. I think it's a terrific opportunity. It's been rewarding investors for the last year. and I think it has tremendous upside. If they keep growing, I think a lot of these stories may prove to be true, which is, hey, robotaxi is going to be big. Great. If Uber can take advantage of that and ride that new wave of innovation, good for them. They can keep growing and growing those cash flows. I think they're going to be worth a lot. What do you think of Uber?
They did announce a partnership this morning to deliver pizza via robots, and it can be scheduled on the Uber Eats app. So that was an announcement they made today. And they also announced a $20 billion buyback.
Yeah, both things are good.
Yep.
What do you think of Uber?
I am a shareholder as well, small, one I'm somewhat playing with. So they've shown a little bit of weakness a couple times here recently. They got as high as 97.71 or so. They're trading below a downward sloping 20. Looks like the 50 is also declining. They're trading below that currently. They are above an upward sloping 200. It may actually be flat at the moment. They did bounce pretty good on their last earnings. Went up for about a week and then it fell back off. I posted a video a couple days ago saying that they were showing some weakness going into earnings, and that seems to be playing out right now. Their RSI is 41, so it's below the midpoint. Their PPO has gone negative. Their money flow is negative. They have outperformed the S&P 500 over the last year by 11.54%. They're outperforming the technology. I have one company that puts them in technology and another one that puts them in industrials. So I guess I don't know exactly where they belong, but they're outperforming the technology sector slightly by 2.65%. The software industry, they're actually underperforming it as of today by 1.94%. I just saw it change. And the software itself is outperforming the S&P 500 by 12. So I also trade them. I can show you some of my trades that I've made. I don't hold very many. I only hold 25 shares. But I sold some options on this and made $900. So that's really helped my return so far, which is about 50% since February. And my total return's been about 43%. I've made 7 trades, and 6 of them are winning trades. One's a losing trade. My gains have been a little over 1,000 and my losses have been $44. So I have a 4.19 to 1 gain loss ratio with a win rate of 86%. So it's treated me okay. But
Yeah, it looks that way.
yeah, it's one that I'm watching. I'm not a huge shareholder. They don't pay a dividend, so it doesn't really fit into my core investing strategy at the moment, but I like it. I'm also invested in Lyft, and they report today after the bell. I do see a big bearish engulfing candle here too. That's a little worrisome for the next few days. That usually indicates you're going to have some downward pressure over the next few days.
Interesting. So, yep. And I think the market, I think we were talking about this early in the stream. It's Some stocks are going up and some stocks are going down, and some sectors like healthcare is getting smashed again. So it might be a time when some things are getting corrected.
Yeah, for people that don't know what a bearish engulfing candle is, it's basically when you're in an uptrend. So it's been on an uptrend for 3 days. And then today's body, the candle, the big red box there, as long as that body completely engulfs the body of the candle on the prior day, that's a bearish engulfing candle. Just so you know what I was speaking about.
Yeah, thanks for the explanation. That's why I like listening to your analysis as I'm learning along the way. Let's talk about Shopify. Why don't you tell us your thoughts on Shopify? The stock is up 19.46% as I speak. So a really nice gain, and this is a pretty sizable market cap.
So this is not one that I typically follow, but they've had a pretty good gain over the past year. They've been trading, I would say, pretty flat since about November of last year. We had all the turmoil in March and April that almost every chart looks identical in that particular time frame. But yeah, it's really shooting up today. Currently sitting at 151.80, trading above all upward sloping moving averages. It did move into overbought territory. So when the RSI indicates a reading above 70, that indicates that it's overbought. PPO has been pretty strong. We did get a bullish crossover. So when the black line crosses above the red line, that's a bullish crossover. Accumulation looks fantastic. Money flow looks fantastic. You have Shop outperforming the S&P 500 by 132% over the past year, outperforming the technology group by 113.95% over the last year. Software industry by 106.4% currently, and that industry is outperforming the S&P 500 by 12%. So you have a strong company and a strong industry in a strong sector. Nothing not to like here.
Yeah, the stock is up tremendously. In the last year, it's up 190%. Just really good winner. It provides e-commerce software. So people want to have an online store, multiple online stores. They go to Shopify, and Shopify provides this, as a service and a reoccurring revenue. So it's nice, sticky business. It is a large market cap, 195 billion. So you're paying close to 20 times revenue. PE is high, forward PE is high. Now, the reason for that is they're growing. They're growing at 29% over the trailing 12 months, and their earnings, they announced that they grew 31%. That's very good growth. So that's why the stock's working. One thing about Shopify is that they provide a hosted service, and it's not quite as profitable as other software companies. If you look at like a Palantir is like nearly 90% gross margins. This one's 50% gross margins, which is a decent gross margin number. It's just not great. Their cash flow is good, but not great. And that's always been the piece that's missing in why I haven't been a Shopify investor is I find other software alternatives that look better, and I've invested in those to my demise, right? Because they're done really well. Analysts, 35 analysts cover it, and they're not able to keep up with this high flying stock. An analyst is pretty bearish at $79 price target. And then an analyst is optimistic at 175, but on the consensus is this stock's worth $118 per share. The forecast for growth, they should continue to grow. That looks really good. That does look really good, but there is such a thing as paying too much for a quality stock in my book. And when I look at the valuation of Shopify, that's what I believe is happening. Is I think Shopify is a terrific business, but in order for me to buy it, I'd have to buy it at a 41% premium. No, thank you. I'm good investing in the other companies. I'll buy them when I think those other great businesses are discounted, priced under their intrinsic value. We just saw Uber. Uber is nearly at $10 billion in free cash flow. These guys are at 2. So it's a very big difference between Uber, Shopify. It's like, wait, I get 4 times the cash flow from Uber? Yeah. For the same market cap? Correct. It's like, okay, I'll take Uber. And even the earnings per share, Uber outperforms Shopify. But this is a stock that has a lot of fans and is bought by a lot of retail investors and is priced quite expensively. Going back to Uber, this is a $182 billion market cap company. So it's a little bit smaller from market cap perspective than Shopify, but it produces more than 4 times the free cash flow. And free cash flow is king in my book. I want companies that are growing. I want companies that are growing free cash flows quickly, because that cash is going to end up in the balance sheet. They can acquire businesses, they can grow, they can make new businesses, they can do all kinds of good things with that cash. And when I compare Shopify to Uber or other alternatives, it's just not an investment I want to make. But congratulations to all those that own Shopify. It's a glorious day to have a stock go up 19%. And it's not a small cap. It's a pretty substantial market cap company. So congratulations to everybody that owns Shopify. I also like saying the word Shopify. So
Yeah, it's got a nice ring to
it. So let's turn our attention to Jackson Financial. And this one you know better than I do. I think you're an investor. And so they do annuities for retail investors in the United States. It operates through retail annuities, institutional products, and life and annuity blocks. So they do life insurance and annuities. Small cap, 6.7 billion. Revenue, almost 1-to-1. Forward P is 4. They pay a nice dividend of 3.5, and year to date's doing 6% with a dividend, not bad. 1 year, 21.75, looks good. Buying at the right time is definitely a good idea with this stock. They announced their earnings, and I'm not seeing the revenue growth. So, yeah, they're not reporting. See, total revenue.
Yeah, they had negative revenue growth this year, which they had at least one quarter last year where the same thing happened.
Okay. And these companies, these financial services companies, this is an insurance company, a lot like MetLife, I guess, and others. It's a smaller version of MetLife, but good income stock. Good income stock. Over the 5-year, it's done really well, up 270%. 1 year, this is a good looking stock. What do the technicals tell you about Jackson?
Okay, so they've been trading sideways pretty much for the last year. I go out a couple of years. I've owned them. Let me see when I first bought them. I bought them in February of 23. So, yeah, I'm way back here. It's a $32 range. So they've kind of flattened out over the last year or so. They were doing really well for a year and a half or so. And even though they reported negative revenue this morning, they did beat on the earnings front, and they're up about 7.1%. And I think their implied move was 9.7%. So they're trading at the upper end of their implied move. And that's another reason why I like to calculate that implied move. Because if you were an options trading person, which I do that quite frequently, I didn't this time. But if they're showing good strength and their earnings are coming due and you have an implied move that large, might be a time to buy an option as long as you can, or trade an option as long as you can get a good price on it. So they are in positive territory on the RSI. Looks like they're having a bullish crossover this morning, and they are in positive territory on the PPO. You can see the big jump in the accumulation as the price was going down. People were buying it like crazy. So that's something interesting.
Yeah.
Yep. Whenever
Well,
I see that, that's really fascinating because that means somebody knows something better than the average investor. So
yeah.
accumulation shot up and has been pretty steady. The money flow is positive. They're outperforming the S&P 500, outperforming the financial sector, underperforming the asset manager industry. And that industry is outperforming the SPY. So Jackson is underperforming a little bit there, but other than that, they are still looking pretty good. And I just continue to hold them because they pay a 3.46
Yeah, you're winning
forward
two
dividend
ways.
yield. Yep.
The stock's going up and you're being paid income.
Yep.
What's there not to like about that? Congratulations. All right, so Peyton wanted us to look at KBYO. Quick comment on ALAB. I took a glance at ALAB and my jaw dropped because it's up 30% today.
Wow.
Nuts. I think there's a short squeeze because there was some short sellers, and I think they're getting really beat up today. So they're probably having to buy those shares thinking, yeah, they grew at 150%. This thing's not going to let up. It's probably going to go up higher. So they're probably closing out their positions. But that's a quick glance at it. Klaviyo is a stock I've never looked at. It's a software company, provides software as a service. It's in the CRM, customer experience realm. It's a data store, segmentation engine for campaigns and marketing, messaging, and so forth. It's business to consumer. So this is to attract new customers. Their website, just real quick. This is their website.
Where are they headquartered?
I'll take a peek at that in a few minutes. So they do data platform, analytics. They're going to compete. I mean, the big dog in this space is going to be Salesforce, CRM, symbol CRM. Your question was, where are they headquartered? They are headquartered in Boston.
Boston, okay.
All right, so $9.8 billion market cap, up 15.64%. They announced earnings yesterday after the market closed. That's a nice gain. $1 billion revenue, so you're paying 10 times revenue. Forward P is 55. They're growing, so I think that's reasonable or rational. It's a buy with a 19% discount. The company trailing 12 months has grown by 34%. And the latest quarter looked really good, 33.26%. The other thing I like about this business is high margins. Gross margins are at 75%. So a 75% margin business, if it keeps getting bigger and bigger, it's making gobs of profit and gobs of cash. Okay. Now, do these guys have the right stuff to take on CRM, Salesforce, Microsoft? Microsoft has a strong suite of CRM products. they're small right now. They're probably not getting a lot of attention from the big competitors in the space. But hey, I tip my hat to their growth. That's good growth for a small company. I'm going to do a quick back of the napkin valuation on this company. I'm going to call it $150 million in revenue at their growth rate and their margins. I say if they don't have debt, and I'm going to look at that next, I think I can go up to 40 times that cash flow. That would be about 6 billion in market cap, and they're above that. So they're higher than that. So they're up 52% over the 1 year. They did come down quite a bit. I don't think their cash flow is high enough at this point, and their revenue is pretty good. I wonder what the problem is. And that's decent cash flow. They should be cash flowing more. I think the cash flow is going to expand as they get bigger and they get better scale. They'll be able to produce more cash flow, but for now, it doesn't look like it's discounted. It's probably priced at a premium. I'd probably be waiting for it to come down. Now, I wanted to look at their balance sheet just to take a peek. Sometimes really good businesses with a lot of debt look bad. So priced somewhat fairly, but probably a little expensively. 22 analysts cover the stock. There's a really optimistic analyst at 60. Not a lot of downside risk. This looks like a solid business. And they're supposed to continue to grow, but as you see, as their number keeps getting bigger, that growth percentage comes down. And I think Salesforce is like 50 billion, 60 billion in revenue. And I don't think they're threatened by this company just yet. So that is Klaviyo. Really nice little business. One thing I've noticed, software companies are not getting a lot of love from the stock market. Not all of them. Like CRM is down this year, and they're growing nicely. So some software companies are looking okay. Some software companies are not looking okay. They're kind of being left behind. And I find it interesting because they have good margins, good growth, good cash flow, but they're just, I guess they're not at the center of AI, and they're kind of being left off to the side while the market really chases the AI story. So that is KVO. The other stock, it looks like little J wanted to look at Chipotle. We can take a look at that after we take a look at Zeta. And I forgot who asked, but one of the members wanted to look at Zeta. It is up 25% after earnings were announced. We looked at this stock, I think, on Monday. And I think my conclusion was, I really want to see the next earnings because it looked good, but man, it's a little company. They're competing, I believe, against AppLovin and other companies that are doing basically helping businesses advertise on Netflix, on YouTube, on Meta, Facebook apps by placing ads most appropriately and getting the best return on investment for that company's marketing dollar. These guys were growing nicely. It looks like probably announced really good growth. It grew at the same rate, which is very good, 35%. I was expecting like a bigger number with that type of price pop. But trailing 12 months are growing at 40%, looks really good. Gross profit, gross margins at 60%, that's good. AppLovin is better. AppLovin has better margins. And their free cash flow is good. See, this is the same free cash flow as that software company we just saw in Klaviyo. This is about the same free cash flow, but I think this market cap is much smaller, 136 million. And if I were to say, based on your growth rate, I'd probably go 40 times. And they're 4.7 billion. So this would be discounted. I thought it was discounted on Monday. It's just so darn little that I'm like, these little companies can really surprise you. And we're so close to the earnings. I wouldn't take a jump into the stock. Maybe other people own it and you're having a terrific day with your stock going up 25%. But this one here is a small cap to watch. I think they're doing terrific. I'm going to watch this stock. I think did I do a valuation on this? I may have. Yeah, I did. So I have them 35% discounted. So remember the back of the napkin I was doing, back of the napkin, I think they're worth. So my back of the napkin kind of high level, my spidey senses are in the neighborhood. So this thing's still discounted even at their current stock price. And it's a small cap. So if it were to settle down, man, I'd probably be a buyer of this Zeta stock. But for now, it's hard to buy a stock when it jumps up so much. I mean, geez, 25%. What do they?
Or goes down like it did last November.
Right. I mean, look at this. Geez, the 1 year down 9%. What the heck? Only up 11%.
Last year they fell 54% in 3 days.
It's a small cap for you. They can rise quickly and they can fall quickly.
And they have not recovered their high from that time period. That was 38.2. And even with today's jump, they're still only at 19.
Well, they're doing the right thing, which is focus on the business, keep growing it, make yourself really profitable, and let the stock kind of go where it's going to go. Investors are going to value you based on how good your profits are and margins and your growth rates. So good for them. Good for them. Just stick to what you need to do, which is keep growing your business. Market will recognize it. So that is Zeta. There was a request for Chipotle. Let's take a look at Chipotle. Now, the reason I don't like talking about food stocks a lot is because I get hungry while we analyze them. In this case here, these guys already announced July 23rd. I'm not a big fan of food stocks because you think about a business, we get choices. What kind of business do you want to own? Well, I'd like businesses that make a lot of money and can grow very fast and have really strong moats. Well, Chipotle sells burritos. Man, I'm physically in San Antonio, Texas. I can go on my map, my Google Maps, and within 2-mile radius, I'll find 25 places that sell me a burrito. So there's not a strong moat. You might say, well, they have a network, right, which is their brand. I'll give you that. But you got to sell a lot of burritos to get to $1 million, and you got to sell a lot of burritos to get to $1 billion. And you have to hire a lot of people, lease out a lot of retail space. There's just so many headaches. I'd rather own a software company, semiconductor company, another business like Meta. Meta doesn't have to clean any tables or do any dishes. They just put their platform out there and people use it. So I prefer to buy businesses that just are inherently have these big advantages from a business model perspective. And I try to stay away from restaurants. There did have periods of time when it did really well. Back here, I observed these stocks, right? It's up 82%. It's not bad, but it's had a pretty nasty correction over the last year or so. And I think everybody can understand Chipotle and their business model. And when we look at their growth rate, it's been growing. But when we look at their margins, this is where I'm like, I'll pass. Gross margins, 40%. Free cash flow, 1.4 billion. They're not growing tremendously fast. They got it every time and they're growing, by the way, they'll grow by creating new locations, and that's an expensive growth model. It's not easy to grow in the restaurant business. So that is Chipotle. They've been around for a long time. They're not going to be like I'd be surprised if Chipotle was a $200 billion market cap company. McDonald's is 200 billion, and they've been around for what, 60 years? That's how long McDonald's has been around. It takes a long time for these businesses to compound, become larger and larger. So today the stock's flat. They announced on the 23rd. So I don't even value Chipotle. I don't track it. I don't watch it. I don't know that I'm watching many restaurant stocks at this time. What do you think of Chipotle, Daryl?
Well, there was a time when they were in a high growth that it would have been a fantastic investment, but it looks, I'm looking at the chart right now, and it looks like it's a watch out below. They're trading basically where they were trading in November of 2023. They did have the 50 for one stock split. So if you owned it back here and rode that out, you're doing very well for yourself. It is oversold at the moment. PPO is negative. The divergence is getting smaller, decreasing. Negative money flow, underperforming the S&P, underperforming discretionary, underperforming restaurants, and the restaurant industry. I think it's the restaurant industry. Yep. So the same industry that McDonald's was in, and they are underperforming that. So this does not look like a healthy price chart to me at the moment.
Interesting. So that is Chipotle, and I'm going to move on before my appetite increases, and I'm going to go to OGN, which is a stock that Mike, the dividend investor guy, is wanting us to take a look at. And this is, I think, Oregon, if I remember correctly, and these guys do products for women's health. So the things that women need, a variety of products. This was a spinoff from, was it Merck? A couple years ago. Man, my internet is slow today. Come on now. There we go. The stock's up a little bit today, 6%. They announced, I imagine, yesterday after the market closed. Wow, look at this discount. Wow, the analysis is over. It's discounted by 112%. Any other questions?
Yeah.
All kidding aside, year to date is it's down 43%. The 1 year, it's down 58%. Jeez. The dividend is really low. I would have thought it'd be really high because it's really coming down. The market cap's nothing, 2.2 billion. Revenue 6.28 billion. Net income is 700 million. Wow, this is really discounted. Now the business is not growing. Why isn't the business growing? They don't have any pricing power. They're not getting more customers. What is going on? Because the spinoff happened, I'm going to say 2 or 3 years ago. So they should be growing by now. That's not overly concerning so long as they're flat, because like Pfizer's showing that they're expanding profits while the business stays flat, which isn't a great story overall, but you know, that's what it is. The gross margins, 56%, pretty decent gross margins. Profitability is there. Free cash flow is there. Yeah, this stock's really discounted, but the market just is not buying it. What's their debt? So they have, call it $9 billion of debt. Yeah, their debt's really high. So that is a problem. Debt's really high. That's a problem. They got to pay it off. They do have some cash. They should focus on paying it off. But boy, the market's just leaving this stock to go down. If they can pay off that debt, this is looking like a really strong value stock that could reward an investor that picks up this stock at a really steep discount, but it's just not working for the past year. Healthcare, I don't need to tell anybody, has just been in a severe sell-off. And this stock is right at the heart of the healthcare space and is selling off. So not a good situation for them. Hopefully things turn around for them. I don't have a valuation on OGN. I think they're severely discounted, but I don't know that the market's going to start buying this stock anytime soon. I would say they're worth probably, I don't know, because they have a lot of debt. I would avoid the stock because of their debt level, but they're probably worth like 5 billion. But they got to get their debt under control because that debt can become really, really toxic. So they got to be careful with that. So the other stock that Mike wanted to look at is DUOL. I'm going to close this browser because it's really slow. Boy, my internet is slow today. I'm going to let Marriott know, hey guys, what's with the internet? Are you hearing me okay, Daryl?
I can hear you okay, yes. It's just screen's moving a little slow, but you're not breaking up like you were earlier.
Maybe it's on the stock analysis side. It's really slow, but we'll see.
It's pulling up okay for me if you want to let me share and you just
Yeah,
guide
let's
me
do
where you
that.
want to be.
Let's do that. I'll put some more quarters in the
There you go.
vending machine here. Yeah, so Duolingo, this is, I think, a software company, right?
Yeah, they have learning new languages. So
Mm-hmm.
they've gamified the process of learning new languages.
Mm. What's their growth look like? Looks good.
35% over the last 12 months. They did have a really big year back in 2020 during the pandemic. Nobody could go anywhere, so everybody decided to learn new languages.
Yeah, I looked at it before we streamed, and it looked interesting. It looked like it was growing. And what's their market cap? Is it a small cap or is it a?
15.3 billion.
So it's a reasonably small cap, so it could go up nicely. So yeah, the PE is pretty high though. PE is high. It's gone up nicely over the 1 year. It's really coming down lately. If you looked at the charts, what are the charts telling you on Duolingo?
They have a declining 50-day. Okay, I'm on the right chart. Declining 50-day, rising 200-day. They're trading below that, and they're also trading below a downward sloping 20-day. The 20 days cross below the 200-day. It looks like if they don't reverse this 50-day pretty soon, that they could cross below the 50-day, which means the price would come down quite a bit and then would be a pretty good buy. They're currently pretty weak on their RSI. They've been oversold, looks like, for 5 weeks. Their PPO is negative. We did have a bullish crossover 2 days ago. little bit of accumulation, negative money flow. They've outperformed the S&P 500 by quite a margin over the last year, 74%. They're outperforming the technology sector by 58%. They're outperforming the software group by 52%. And the software group industry rather, is outperforming the S&P 500. So they have some good things going for it, but I think you have a possibility to pick it up a little cheaper here in the not too distant future.
Yeah. I finally got my computer to work a little faster, and I was able to see that I really like how they grew their free cash flow. Their free cash flow growth is a really nice trajectory to it. So it's showing that, hey, they're probably going to ramp up their free cash flow. And I think this stock is priced a little expensive, probably 20-30% a little too expensive, but it's an exciting stock. It's a small cap. If it did continue to settle down, because it's up like more than 100% over the 1 year, this thing may come down to a price that's really attractive.
Definitely one to watch, I think.
Yeah. And let's end things with AXON. Let's take a look at that one. I think Carlos wanted to look at that. If you wouldn't mind taking us through that, because my computer for some reason, stock analysis is not running quickly for me.
Yeah, I wish I would have bought this one a long time ago. It kind of falls into my work history over the last 40 years, so I'm surprised I didn't pick this one up. They're a competitor to the company I worked for 25 years. It's been pretty exciting. I wish I would have picked this one up. They're based out of Scottsdale, Arizona, and they do a lot of cameras for law enforcement. They're working with AI to take law enforcement reports and to analyze them and make them better that can be reviewed by the law enforcement official later on. So they've got an AI play as well. It's a pretty exciting company.
Man, their stock is over the 1 year 194 rise,
Yep.
194% rise.
I should have. I've been watching this one for 5 years, so I can't believe I haven't jumped on that. And basically, it's not really within my strategy at the moment. So that's the only reason I haven't. But I've been watching this one for a lot of years.
You know, one of my favorite movies, it's a little bit old, but a great movie, RoboCop. Remember RoboCop?
Yep, there you go. I've watched it a bunch of times.
These guys are going to create technologies that are not necessarily going to be like RoboCop, but that's the point. Is like, hey, law enforcement. Those writers of that movie kind of saw the future coming. They're like, hey, yeah, the future is going to have this kind of thing.
Yeah.
Yeah, this looks like an awesome stock. Now, is it priced attractively or is it too expensive? Let's take a look. So I'm going to try to get my internet to work, or at least stock analysis to work. It's still not working for me. So I'll have to, on a separate occasion, do a valuation on it. But the price has gone up. One thing about like aerospace and defense specifically, it's expensive. It's really expensive. And I know the big story. It makes a lot of sense. Other countries have to start defending themselves. There's going to be long-term demand for aerospace and defense. Got it. But aerospace and defense companies are not overly profitable. They tend to have lower profits. And that extends a little bit into other spaces. So I would say that's one of my cautions when I look at an Axon. All right, so what's the market cap on Axon?
67 billion, 68 billion.
So you're paying like 20 some odd times revenue?
Yep.
Man, that's expensive. The PE is really high. And how are they growing? Like, are they growing really fast, or what's their growth rate?
Twenty-eight 28%. Well, now let's get over here. So 30%, 23%, 19. So probably 25% or so on average over the next 3 years. Let me pop them into fast graphs. AXON. Yeah, they're definitely priced pretty high. We're looking at a 20-year range here. They pretty much traded at their market PE since the beginning of end of 2018. They're above their fair values calculated by fast graphs, which is 16.05 times. So
Yeah.
they're definitely, I don't know if this is the best time to buy because they're priced over their market multiple. So even if you held them for a couple of years, if they trade back to that normal market multiple, you're looking at a loss over the next year and a
Yeah,
half,
that
2 years.
just looking at the 5-year, it's up more than 900%. It's like, wow,
Mm-hmm.
man. And then the 1 year, it, I would be apprehensive. I'm like, geez, that thing's got to settle down one of these days.
Yeah.
So I'd probably be very cautious not to buy at a high, and then because once a stock like that, if they have the goods, right? Now the growth they have is good, but it's not like tremendous, like 80%, right? And so forth. And if they were to hit a wall on growth, that stock's going to get hammered. You could be sitting on a 50% loss if you buy too high.
Yeah, I think currently it'd be a little risky to if you hold shares, I think you could probably definitely hold them if you've held them for a while because you're doing so well. But there's definitely some risk right here.
Yeah,
I mean,
yeah,
I'm
but it's
even
an
going
exciting
out
stock.
to what's that?
It's an exciting stock.
Yeah, there's no doubt.
All right. Well, we can end it there. Really good stream. Thanks, Daryl, for jumping in and covering the live stream with me. We covered a lot of ground today. Geez, we covered about 10 to 12 stocks. It's interesting to see some stocks are just flying up. Some stocks are coming down. As I speak, the market's up. S&P's up 0.4%. Nasdaq's up 0.55. So the market's having a decent day. But some stocks are just flying up, like Shopify flew up and others. And some stocks are selling off, especially health stocks. So
We did overlook one question, and I'd like to hear your thoughts as well. From Sargil, he said, "What's with health stocks?" Let me see. I can't put it up on the screen. What's with health stocks? Look at Elevance Health, just tired holding it. No move whatsoever. Your thoughts, please. Thanks.
yeah, you know, um, so healthcare stocks have had a couple of negative stories that are causing an overall story problem, right? You got the government that's saying the big bill took dollars out of healthcare. And another story, like they're going after United Healthcare. Latest thing is the president's saying he's going to the pharmaceutical companies and saying, you got to lower your drug costs. And the next thing you know, he's like, well, while I'm at it, hey, I'm going to put a $250 tariff on drug stocks. It's like, God, man, can you give somebody else a turn on all that, tough love? So there's just story after story, just scaring away investors for healthcare. That's the big picture. I think a lot of stocks are tremendously in healthcare. I just think if you're going to invest in healthcare, you're going to have to be patient. It's not going to be an overnight thing. It's going to be 2026, maybe in 2027, the space rebounds. So I'm being very careful not to buy into healthcare all that quick because it's just not working. And it seems like one story after the next just hitting the space.
Yeah, I'm in the same position. I'm in UNH. When it dropped, I started moving in slightly, started a position. I can see on the relative rotation graph that it's in the lagging quadrant, means it's underperforming the SPX on both relative strength and momentum. But I see over the last 3 or 4 weeks that it is starting to improve. CNC, on the other hand, Centene, that is continuing to lag and even get stronger. This is Molina Health. They're kind of in the same position. There's Elevance Health. They're all in the lagging.
Yeah.
We do have some that are in the leading quadrant. But I'm like you. I think this is a long-term play.
If you're in a if you're a 35-year-old to 45-year-old and you're like, I don't want to touch this money for the next 20 years, not a bad idea to keep your eye on healthcare, because I think there's some companies you can probably buy and sit on at a very good, rate of return. But the stories have to change, and it's been incredible to see. And it seems like healthcare is a popular, typical punching bag. Politicians love to punch on healthcare. Oh, the pharmaceutical companies are terrible, and so forth, because healthcare is so darn big. It's such a big part of our economy, and it's important to people. So,
And
I think
you have a population that includes my age group. I'll start Medicare next year. So you have a large group of people that are going to every single year are moving into Medicare. It's not going away, that's for sure.
Yeah. So be patient, but as we end the stream, just taking a peek, what is moving Apple? What happened?
Trump was going to make an announcement. I saw a headline. He was going to make some announcement about $100 billion investment they're going to make.
Apple was?
Yes, I don't know what that includes or when the announcement is going to be, but I saw a headline a little earlier on that. Lil J said they had an announcement.
Mm-hmm. Amazon's up. I'm a bull on Amazon. I've been accumulating that stock. Palantir's up. It's up 3%, I think, every day. It's up so much. Walmart, go Walmart. Costco, Tesla, Netflix, looking good, looking real good. So we'll see where the market trades.
Yeah, it all started about 10:30. It looks like it's been on the rise because it was decreasing till about 10:30.
Mm-hmm.
Oh, my time. I'm in Central Time.
Yeah, we'll see.
No, this is Eastern Time. They don't change it for me. So
I think the Apple story, that 100 million might be kind of a deal made, with the president, where, hey, we can't move our production out of China. It's just impossible. But what if we made a huge investment in the U.S.? All right, that sounds good, because that's a good headline. And so I think it's a compromise. Like, hey, they're going to be allowed to continue to produce in China, but they're going to make this massive investment. That's my guess.
yeah, I haven't seen any of the details on it. The market still seems a little bifurcated this morning. You have consumer discretionaries at the top and consumer staples right after it. Both of them are up about 1.4% on discretionary and 1.3% on staples. Those are two opposite
Mm-hmm.
investment styles, and yet they're both at the top.
Interesting.
Healthcare is at the complete bottom today.
Again.
Again, yeah, that's been my constant theme. Yeah, the markets, I'm looking at the advancers and decliners, and it's about split in all of the markets. So there's
Mm-hmm.
very little that's changed. So I don't know. It
Yeah.
could be an interesting day. We'll see what happens.
Yeah. We'll see. I'm gonna get going. I'm gonna study what's going on with my portfolio now and see if I can make sense of it. Thanks again, Daryl. And
Yeah, thank
everybody,
you, Victor.
the very beginning of the stream details is Daryl's information. Please visit his channel. Please subscribe to his channel. Please help grow his channel. He does a lot for our community, and I appreciate it very much. He brings a lot to the table when it comes to knowledge, and I thank you for it, Daryl.
Well, thank you, Victor. I appreciate it and glad to be here.
All right, guys, enjoy your day, and we'll catch up soon.
Trade well.